All right, let's get right into it. Today, we're doing a deep dive on the upcoming IPO for Nuobikan. Now, this is a company with a really slick, high-tech story. But as you know, our job as investors is to look past the shiny story and dig into the real numbers. So the big question is this a golden opportunity or is it a carefully disguised trap? Let's find out. So to get a handle on what these guys actually do, here's the best way to think about it. Nuobikan isn't building the trains or the power lines themselves. No, they create these incredibly smart AI systems that act like a full-time doctor for this critical infrastructure. They're constantly scanning, looking for tiny, microscopic flaws before they can turn into massive, catastrophic failures. It's a fantastic concept, you have to admit. And that's the multi-billion-dollar question, isn't it? The story sounds amazing, but before we even think about putting our capital on the line, we've got to run our own financial health check on the business itself. Okay, so first up, let's understand the fundamentals. How does Nuobikan actually make its money? Well, the whole business really stands on three core pillars, and each one targets a huge state-controlled industry. And what's really fascinating when you look at the breakdown is just how concentrated they are. I mean, rail transport and energy solutions, together, that's over 95% of the company's entire revenue. Urban management, it's barely a rounding error at this point. So let's break that down. The rail business is their bread and butter. This is where they sell these super sophisticated 4C inspection systems to China's massive national railway network. Then you have the energy segment, which is really their growth engine. They're taking similar AI tech and applying it to the huge power grids, like the ones run by State Grid. And that last little slice, urban management, that's more about smaller project-based stuff, like installing smart cameras for campuses or city parks. Now, you might think their big advantage, their competitive moat, is all about the technology. But it's actually a bit more subtle than that. The real wall they've built around their business is trust. Getting certified as a China Railway Group A-level supplier, I mean, that's the highest possible stamp of approval, is a massive barrier for any competitor. In these industries where failure is not an option, a proven track record is worth way more than the fanciest new algorithm. So you've got a solid moat, you've got huge state-owned clients. It all sounds pretty good, right? So what's the catch? Well, this is where we start to peel back the layers and look at the financials. And yeah, this is where things get complicated. All right, let's dive into the financial health check. And honestly, the entire story of this company can be summed up by looking at just two numbers. Two numbers that paint a completely conflicting picture of what's going on. So on the surface, things look pretty good. In 2023, the company posted a net profit of 88.5 million yuan, a growing profitable tech company. I mean, what's not to like, right? But here's the other number. In the very same year, their operating cash flow was a staggering negative 99.9 million yuan. So here's the crucial point. They are booking profits on paper, but in the real world, cash is flying out the door at an alarming rate. And look, this wasn't just a one-off bad year. If you look at the data, this huge gap between profit and cash has been going on for a while. Now, you might see that cash flow did turn positive in 2024, but don't let that fool you. The underlying structural problem of booking profits without actually collecting the cash is still a massive concern. So why? Why are they burning through cash when they're supposedly profitable? Well, it all comes down to this one absolutely shocking number, 373 days. What could that possibly be? That's how long it takes Nuobikan to get paid after they've delivered their product and sent the bill. More than a year. Now, compare that to how fast they have to pay their own bills to their suppliers, just 108 days. This huge gap means Nuobikan is basically acting as a free bank for its giant state-owned customers, and that is putting an immense squeeze on their finances. And this cash problem gets amplified by their extreme reliance on just a few customers. In the first half of 2025, their top 5 clients made up nearly 75% of their revenue. And get this, a single customer accounted for over half of all their sales. This gives them practically zero bargaining power and creates a massive, massive single point of failure risk for the business. So the financial risks are pretty glaring, but they're not the only ones. We also need to take a hard look at who is actually running this company and how stable the business model really is. And when you do, you find a few governance red flags. First, the founder has absolute control through a special agreement. More concerning, to me at least, is that the chief financial officer is his sister-in-law. That raises some serious questions about independent financial oversight. You also see that they previously tried to list on the mainland A-share market and then abandoned the attempt, which is often a sign that regulators started asking some really tough questions. And beyond who's in charge, the business model itself looks pretty shaky. Their gross margins are all over the place, swinging wildly from one year to the next. For instance, their energy solutions margin just collapsed, going from almost 50% down to 16.5%. That screams weak pricing power. It suggests they're totally at the mercy of whatever their powerful customers demand. Okay, so after weighing all of this, the cool story, the worrying financials, the governance issues, what's the final call? Let's pull this all together into a clear strategy. So here it is, laid out plain and simple. The bull case is that they're a market leader in a protected niche with a great story and big clients. But the bear case, honestly, is overwhelming. You've got a severe cash flow crisis, dangerous customer concentration, almost no bargaining power, and serious governance concerns. You know, one of the analyses I read summed it up perfectly. Nuobikan is a company that can probably survive, maybe even do okay, within its little niche. But the fundamental flaws baked into its business model create major obstacles that will make it incredibly difficult to ever become a high-growth giant. So, because of all that, my decision is to place Nuobikan on the maybe pile. Look, the potential reward if everything magically goes right is decent, but given all of these red flags, the probability of actually winning that bet, what I call the win rate, it just feels too low. It's a highly speculative play at best. And here's how that fits into my bigger strategy for this IPO cycle. My main capital is going towards my high-conviction plays, Zhihui Mining and HanXBio. Nuobikan sits on that secondary maybe list, with a couple of others. It's for investors with a much higher appetite for risk, but it is not a core position for me. So, I'll leave you with this one final thought. The company is asking for a valuation between 24 and 32 times its earnings. For a business that has to wait over a year just to get paid, is that a price you are truly willing to pay? That's the question every single potential investor needs to answer for themselves.